What's up, guys? Welcome back to my YouTube channel. Today we're going to talk a little bit about retirement, the differences in accounts, a few of the strategies that a lot of people take, how easy it is to actually accumulate wealth over your lifetime, and just all of the little steps that need to be taken in order to be successful and end up wealthy at the end of your career. Let's get into it. So where exactly do you start when it comes to investing? There's real estate investment, there's investing in the stock market. People say that I'm going to invest in a new car, which if you haven't figured out is probably the worst investment out of what I've already listed since they go down in value. But an investment is anything that typically goes up in value and that you can put money into and then pull more money out of later on. So the safest, most standard type of investment that people talk about when it comes to retirement is mutual funds. Single stocks we'll talk about a little bit later, but for the most part this video is going to be entirely about mutual funds. So what exactly is a mutual fund? Well, really a mutual fund is just a bunch of single stocks that are compiled together by somebody that you can then buy that mutual fund instead of going out and having to buy small percentages of each of these other stocks to be diversified. This diversification is very important when it comes to market volatility. You don't want to have all of your eggs in one basket when it comes to investing. Let's say hypothetically there's a huge problem one year with tech stocks. Now, if you were invested just in tech stocks, you would take the 100% brunt of whatever losses were seen in that industry for that year. When it comes to a mutual fund, though, you might have a couple percentage in these tech companies, and then you have some percentage in oil, and you have some percentage in medicine, and you have some percentage in you name it. So you can really pick mutual funds that are going to be very spread out and diversified that keep you from losing as much as you would if you were in just single stocks. The reason that's important is because there is market volatility. You don't know what the next big problem's going to be with a company, so you want to have your money spread out so that if one sector sees a 10% decrease but a few other sectors see maybe a 3 or 4% increase, you're not taking that full 10% drop, and when the markets bounce back you're not coming from as low as a number. So let's talk a little bit about retirement accounts and the different kinds out there. So if you work for a company that's relatively large in size or just has a good benefits package, there's a lot of them out there, hopefully they have a company-sponsored 401k plan. Now, what is a 401k and what's the difference between a Roth 401k and a traditional 401k? Well, a Roth 401k means that the money that comes out of your paycheck and goes into retirement is post-tax, meaning that taxes have been taken out of it, and it comes out of what your net pay would have been in that paycheck. The benefit to this is that down the road when you retire in 10, 20, 30 years, all of the money that you've put into a Roth type account is tax-free, meaning that if you put in over the course of your lifetime $180,000 into retirement very religiously, you will have probably close to $1 million in that account. You paid taxes on $180,000 that were put into that account, but you get the $1 million in that account tax-free, meaning that if you wanted to take $1 million out of that account one day and just clean it out, which I don't recommend, you wouldn't have to pay taxes on it in the next tax year. Now, when it comes to traditional type accounts, traditional 401ks and traditional IRAs, they work the opposite. The money gets taken out before taxes come out, meaning it's pre-tax. The reason that you would do this is that if you were trying to lower your taxes in a certain specific fiscal year, meaning that if you put $10,000 into your 401k, your traditional 401k, you would be able to deduct $10,000 off of your income for the next tax year. So you would have your standard deduction or whatever itemized deductions you would want, plus you would get to take another $10,000 off of what you got paid for what you would actually pay taxes on for that year. When it comes down to it, you can do your own research. I personally choose the Roth because I'm only 30, and by the time I reach retirement age of 59 and a half, I have a feeling that taxes will most likely be higher than what they are now. So if I'm going to be living off of $50,000 a year in retirement, I'm assuming right now that the tax bracket for $50,000 a year is probably going to be higher 30 years from now than it is today, because over the course of time, taxes typically rise. At this point, you might be saying to yourself, well, I don't have a retirement account at work. My company doesn't offer a 401k, so does that just mean that I'm screwed? No, it doesn't mean that you're screwed. you can go and open an individual retirement account, also known as an IRA, at really any financial institution out there. I think some banks are even offering retirement accounts at this point. Not that I would recommend investing with a bank, but that's a whole different point. Some of the most well-known companies out there would be companies like Fidelity or Charles Schwab or Vanguard. All three of these typically have very good rates of return in their mutual funds. Their mutual funds are put together by experts, and they usually have good track records. Almost all of these accounts these days can be opened online with little to no hassle whatsoever. So there really isn't much point in saying that, oh, I don't have time to set up my retirement, because it can take you as little as 10 minutes. One of the last things to consider when it comes to picking mutual funds at some point, whether you're in a 401K or an IRA, is an expense ratio. So an expense ratio is basically how much you will be charged for the person managing that mutual fund. Vanguard, I think, on average has the lowest expense ratios out of most other companies I've ever seen. But as long as your expense ratios are relatively low, and you can look up what the averages are and do your own research on that matter, you want that number to be low, because that's how much you're going to be charged per year to be in that fund. And they're usually like points of a percentage. We're not talking about huge fees and stuff like that. We're not dealing with banks and overdraft fees here. We're talking about small percentages, small percents of a percent that millions of people pay into to make this company money for all of the time and research that they put into putting these mutual funds together for you to purchase. Now, I'm sure everyone out there has heard about compound interest. If you haven't, sit back and take a look at what can happen. So I'm going to come at you with a hypothetical real quick. Think about yourself, how much your car payment is every single month. And right now I'm going to tell you that the average car payment for a new car in the US right now is $554 per month. That's a lot of money. Now, if you were to start retirement with zero in the bank and a $554 payment every single month for 30 years, you would end up with over $1.1 million if the market had a rate of return on average of 10% over those 30 years. And honestly, 8 to 10% over the course of 30 years is what you should expect in good growth stock mutual funds, that you don't pull out when the market freaks out and you don't change your habits. You just put that $554 per month every single month into that account. You forget that you even have that money, and it just goes away. And then once you want to retire, you just have $1.1 million sitting in an account waiting for you. And here's some things to not worry about or do if you are currently invested or are about to start investing. Please don't panic when the market drops. If you were to have panicked when all of the wellness stuff was going on a couple of months ago, when the market was tanking day to day, you would have lost ridiculous amounts of money. If you had never touched your money starting in January to right now, you still would have a net gain in the stock market within your mutual funds, because the stock market goes up and down. There's really no way to predict a lot of the things that are going to happen. And if you try to play the game of predicting the stock market, you're most likely going to lose in the long run. So just buy it and leave it alone. This is a buy once, leave it, pull it out when you're going to retire kind of plan. It's very simple. It's like the subscriptions that you have that you forget to cancel. Just think of it like that. It's a subscription that you've forgotten about. You're paying $500 a month to just forget that that money is anywhere, and don't freak out when it starts to go down. One of the scarier statistics to try to keep you away from the day trading is that typically 80% of people who day trade lose money. It's just those small percentages where they actually hit a big win that they make a lot of their money on. Now remember, saving money is just like any other habit. You have to do it and do it consistently for it to become a habit that you don't have to think about anymore. And you might screw up from time to time. Maybe you're gonna mess around with your investments and you're gonna get burned a couple times and realize, okay, that was a bad idea. Let's just set it in there and let's leave it alone. So don't get discouraged if you're having problems, or if you think you're too far behind or you're too old to start this. This is a thing that anyone can do at any age. You just have to put more money into it the older that you get. So the earlier you start, the easier it is going to be on you every single month to come out with the same amount or even more money than the guy who started 10, 15, 20 years later than you. I can't stress enough how beneficial it is to work for a company that offers those 401k plans. One, you can put more money in per year versus an IRA, which allows you to invest larger amounts of money for longer and still have an IRA to invest the max of both to maximize your investments the older that you get. And two, it's really nice to be able to have that money come out of your check just like maybe your health insurance does before you even get a chance to spend it. That's how mine is. I put 6% in, my company matches 3%, so I get 9% going into my account every single paycheck, and I don't have to think about it. I still see my net pay after all that money has come out, and that's the money that I use to budget with for that month. I always know that I'm gonna have several $100s less in my paycheck because that money is already accounted for, it's already in a different account, and it's growing. So no matter what age you are, start building these habits so that you can retire at whatever age that you want to with whatever amount of money that you're willing to put in to then grow. Mess around with an investment calculator or any kind of compound interest calculator to get yourself excited. I like looking at, hey, how much would I have in 20 years if I upped my investing by, I don't know, $50 or $100 every single month, and you'll be really surprised at how much more money you will have if you can start cutting a few things out or going in and getting yourself raises so that you can put some of that raise money towards more investing. So now that you've heard a little bit about investing, I want you to think about your situation for you. Does your company offer a 401k and are you enrolled in it? How much do they match? Is it a Roth or a traditional? Take some time to look at a retirement calculator and figure out how much money you need to be saving with an average of 8 to 10% in the stock market over the course of however many years you plan on working to see how much money you need to be putting into an account so that you have a goal. If you're investing just to invest, I'm not going to be mad at you. But if you have a goal in mind, just like with anything else in your life, if you could focus on something and see a finish line, it makes the process that much easier. So that's pretty much all I got for you guys. Hopefully you found this informative. If you have any questions, drop a comment down below and I'll get back to you. If you liked the video, click like. And remember, if you want to retire at a young age, start investing now. If you don't want to retire at all, I'll see you at work when you're 85. I'll see you guys in the next one. Have a good one.